Treasury yields made a big move higher today as some news breaks that there's more optimism about a deal getting cut with China over trade. Likewise, some positive news from across the pond on Brexit. And yeah, there were some mediocre auctions that also were sort of aiding to the rise in yields. But ultimately, I think this is all very short-sightedness. I mean, if you think about it, a lot of what's happened in China has been going on for some time. The Brexit news is in, it's out, it's good. And, you know, really today's auctions were like someone handing you a peanut butter sandwich. They were just not all that great, mediocre at best. And I think as we go forward, the only keys that you want to remember here is that the only resolution we do know is that the Fed is on pace to cut rates at the end of this month, that economic data has been trending lower, and really there is no clarity in those other issues yet. Now, when that clarity comes, obviously the market will react as it has. With good news, yields will rise slightly, and with bad news, yields will go down very quickly. But at this point right now, seeing yields creep up to the mid-160s in the 10-year bucket shouldn't be an alarm. It shouldn't be creating any alarms or causing any concern. And we're back towards that old range. Certainly, we came in this morning, we were trading around 155, so the range today was pretty wide. We ended on the highs, but a lot can change overnight, especially if any of that optimism starts to sour a bit. And if you look at volatility, market volatility softened pretty much today. We call it following the trend. Even though yields just moved today, volatility was reading in the tea leaves, I think, or market participants were looking for some kind of a move like this. And so as we see volatility decline, we see it on the heels of yields rising, going back into that old range and at least getting away from those uber lows that the market is looking to or had been looking to trade towards over the last several days. So at this point, yields going higher is going to be affiliated with lower volatility until they get to a certain point, probably somewhere closer to 2%, which seems like light years away at this point, that you have to see volatility break out to the upside on any rise in yields. And lastly, we are looking at a lot of things here and there and where, but ultimately the market is going to be focusing clearly on the last week of October, because if you look at that week, we line it up with an October FOMC meeting, a Thursday Brexit announcement, a Friday Ms. Lagarde will take over at the ECB along with the October employment report. So there's a lot going on in that last week. Between then and now, it's all going to be hearsay whether or not we get a deal with China, whether or not things are good with between the UK and the EU, and certainly as we start to look at demand for treasuries and as one of those two events starts to look clearer. But again, we've seen this flight to quality bid for quite some time. Just because we have one day where yields rise very sharply, I don't think that establishes a trend just yet. So let's wait and get through the next 2 weeks, get to that last week of October. That's where all eyes will be focused. Hear what the Fed has to say, because they've been wanting to pull back on their dovish stance. However, I'm not sure they're going to get an opportunity to if the data isn't supportive. Likewise, I think that the market continues to price very aggressive Fed cuts, something the Fed would like to talk back slightly, but have been unable to do in recent weeks. So as we look at 10-year note yields on the rise, it is good to see yields refreshingly off the lows. However, I'm not sure for how long.